Thank you for coming tonight. We're going to talk about personal finance. This session will go really, really well if you have questions and we have a lot of interaction. As normal, I don't prepare very much for these things. We'll go with the flow. Also for our audience out there, that one thing you should never do is bet people when you don't know you can win. That about 3 weeks ago, we're trying to get some interest up for our homecoming 5K race. And I foolishly bet our students that no one could beat me in the 5K. Then we have some crazy Englishmen like this guy back here, JJ, who used to play tennis, not very well, but he played tennis. But he can run a little bit. And there was about 4 or 5 other business students, one of which I heard ran the Boston Marathon, which I don't think is fair, that beat me. So today, they dyed my hair red, which is why I'm here. And now we're taping this lecture. So we didn't mean to time it that way. But with that, my name is Tim Muth. I teach in the College of Business. Actually, in the spring, I teach a semester course called Personal Financial Planning. And interestingly enough, about half the students I get typically are engineering students. Usually seniors, now that get a lot of financial stuff in school, so I take that class. That one's really brought down to a personal level, very, very practical. Talk about things you're going to run into pretty quickly after you get out of there. And hopefully we talk about some of those things tonight. But first I'd like to start off with what I do in that class. I got a hold of this thing. It's called a money attitude survey. Get your thoughts about money. It'll take you just a couple minutes here. Take a look at this, and we'll use this as a jumping off point. Take one, just pass it back. Have enough over there? Do you want to put that back there? Just the front. There's one that says money attitude comparison, 10 questions. Thank you. In the College of Business, we have more than 10 questions. The students would freak out. They're usually true false, otherwise they'd never graduate. I'm just kidding. No. There's hope for you. You need a pen? That's a typical business student. There you go. I think the choices are 1, 2, 3, 4, 5. The MBA students have their calculators out trying to figure out the answer. Engineers have slide rules. A couple of laptops. Wow, no phones, that's good. Will this be streaming live tonight on Netflix? Disney Plus, yeah. They got 10 million customers the first day. Cool stuff. Come on in. Plenty of time. Got a seat for you right here. You're taking a final exam. I don't know whether you graduate or not. All right. Well, we can get diplomas back. We'll give it another minute or two. You can work on this one later, JJ. It'll be homework. That's a true business student. Didn't read a book in 4 years. That's still amazing, all of us. All right, why don't we just move forward? You can. Why do I start off with this? See, Young man right here. I don't know the names yet, I'm sorry. Luis, why did I ask you to start off with that? Beginning of the seminar.
To get an idea of how hard personal finances, or do we know how important personal finances are?
Well, this is more individual to you, though. We don't know if it's important yet or not. Would you mind to- How about young lady over here, Scarecrow?
Oh, scarecrow.
Is that what it's, Scarecrow?
Yeah, or it's a skeleton. Either way.
Oh, it's something to do with your major?
The skeleton?
Yeah.
No.
Biomedical? No, okay.
No.
All right.
What was the question?
Why did I give you this?
To see how we feel about money and how it influences us.
Okay, really good. Why is that important? I pick on Linda? She had a great answer. To know about her feelings on money and how it might influence her. Why is that a good place to start personal finance?
Because people spend money based on how they feel at a certain time.
Okay, does everybody spend it the same way? Everybody have the same feeling towards money? No. Some would like to spend a lot, some are savers, some are somewhere in between. So one of the things I'm going to talk about tonight is really important to know where you are. Because when you tend to go against what is good for you, makes you feel good, that's probably you're doing something you shouldn't be doing. You know, if you get sort of that stomach is upset, or I always call it, I get the feeling to jump off the closet. I live over that way. That, you know, so I'm doing something against my natural nature. And that's certainly true here. You know, you get calls from someone at the library and says, hey, we got $5 million down at the front desk of the library for you. What should you do, JJ? People just give you money out of the goodness of their heart? Go away. Well, I think it's just your antennas should go up and go, well, you know, I don't know about that. You've got to think about that a little bit. But so that survey, when you get a chance, take a look at that. Very important to know where you are and how you view money. Some of you may be married or have boyfriends, girlfriends. It's always interesting when your spouse or significant other views money differently than you. In my family, my wife and daughter would spend every cent we had. And I tried to save every cent. So we had some interesting discussions. But unfortunately, they won every argument. I always got outvoted. I tried to get my son to vote with me, but he would be neutral. I think my wife was bugging him or something like that. One other thing. So if you, I'm going to start talking about these here. If you take one on this side, 10 Commandments. And hopefully I don't offend anybody with the biblical reference here. But I tried to distill, let me just grab one of those. Yeah, just one. You put those behind you. So I use these as points that get us into discussions. And please, as we go through, if there's reasons you're here, questions you've got, bring those up. One I feel is really, really important is that number one. I was fooling around with JJ about. If an investment seems too good to be true, it probably is. Stay away from the get-rich-quick, high-yield, high-quality, no-risk, guaranteed investment schemes. Because folks, guess what, Zach? There's no such thing as an ironclad guarantee. You invest in something, you hope it goes up, but it could go down. And time frames are important too. You know, you get those calls on the phone about, all you have to do is return this call and we got a big cash prize for you. Or your uncle back in Nigeria has got some money, left some money to you, just wire transfer. Well, the one that always gets me, I think Nancy fell for this one. You get the recorded call, hi, this is the IRS, you owe us $5,000, go out and get Amazon gift cards, bring them to the post office and mail them to us. Now you wonder, why would anybody ever do those kind of things? But time and time again, people are gullible. So I hope, if you walk away with nothing else tonight, think about that first one. If it seems too good to be true, it probably is. And you can talk to them, but don't go parting with any money. Don't go give them credit card numbers. Don't Venmo stuff to them. Don't give them Social Security numbers. That'll save you a lot of money. You know, the worst thing is, as people get older, like me, a little feeble. People take advantage of us. You know, my dad's 96, and luckily we keep him away from the phone. If somebody like the IRS said they were calling, or some other government agency, he'd give whatever they wanted if he's going to go to jail. But you guys are young and you got good minds. And 2 relates to what the survey I gave you. Understand your personality type, ability to tolerate risk before investing. Make sure you can sleep comfortably at night. Because if you have really, really aggressive stock portfolio, you're saving for, so what would you be saving for right now? Let's see, gentleman right here. Do you have anything in the next 5 years you want to buy, do, that you might be saving for now?
Not currently.
Okay. How about young man over there?
I'm saving for maybe grad school.
Okay, all right. That's, how much will that take, approximately?
How much?
How much you have to save?
I
If you're going to Florida Tech, what, 2 or 3 million a year? High quality instructors? But that's a good one. Say you have to save $50,000 next couple of years or something like that. Or some of you may be buying a new car when you graduate. A little bit further out, maybe thinking about a house, having a down payment for a house. So when you have a time horizon and you need money at a certain time, that's going to tell you, you know, you have to invest it maybe somewhat aggressively for it to grow. But boy, if you're watching the stock market every day, and it goes up and down all over the place. I'll show some slides later. But some days it's like crazy. And we were talking before about U.S.-China trade dispute. You know, the days it seems like things are not going well, the market will fall quite a bit. Then all of a sudden someone will say, well, I think we're going to have an interim agreement. And the market goes back up. But the day-to-day swings can be dizzying. But if you're saving money for something that's going to be 5, 10 years out, you want to pick something that you're comfortable with. You can ride out the ups and the downs. All right, another one for you guys here. Start saving early. Always remember the lesson of compound interest. Now we're going to get wonky. First, you guys are young. If you turn this sheet over, one of the most important concepts in personal finance, called the time value of money. Let's get the next one someplace. The next one back there. So let me ask a question, real smart business. Zach here. Would you rather have $1 today or $1 5 years from now? Wait, he's smart. You got to think about this. Let's take him half an hour. Do you rather have $1 right now, or if I come and give it to you in 5 years?
I'd rather have $1 now, so I can put in the stock market and be worth more than 5.
All right, so if you had it now, you can invest it and hopefully get a return. Why else do you want it now?
Inflation.
Inflation. What the heck is this inflation stuff?
Hmm?
What's inflation? She didn't tell me you were going to ask about that.
Value of the dollar decreases because
What?
the money supply increases and stuff like that.
What's your major?
I mean,
No, you don't know stuff. Discipline. Well, I mean, it just says prices go up over time,
yeah.
right? So something I could buy today for $1, it may be $1.25 sometime out in the future. So I damn sure want that dollar now, like Zach said. At least if I have the dollar, I can go put it in the bank and get something. Or he's going to roll the dice, try to get big returns. So it's a very fundamental principle. Given a choice, rather have money now. And one of the things with what you're talking about, we call it compounding. But not, the first dollar he has is what we call the principal. But then he earns money on that. Let's say it was $1,000 I gave you. I put together this is a PhD level finance problem here. See if Linda can follow along with me. So she's got $1,000, 10% return per year. These two financial whizzes back here investing for me. And they're holding it for 5 years. So if I was a Chem E major, I'd say, all right, 10% per year, $1,000, I'm gonna get $100 a year. Right? Did I do the math right?
Yeah.
Good, good, good. These guys are doing their fingers and stuff. But if you look at that example, so the first year, they earned $100. The library people follow me, or should I slow down for you? And the students might get this right away. So at the end of the first year, I got 1,100, Nancy. Zach and I are rocking and rolling, 10% per year. Our financial advisors took care of us. And that second year, I now have 1,100 earning 10%. And lo and behold, how much did I get back the second year? How much did I earn in return? 110. That's $10 more than 100.
Yep.
Oh, that's compound interest. I earned interest on the interest. So that 100 I had, when I put that back in to my account, 10%, that's $10. That's why, given a choice, like sometimes you guys have stocks, that this crazy thing called dividends. You might want to have them send you a check and you go spend the money, but you want to reinvest it. Because that money keeps going. Same thing with your certificate deposits. Reinvest it. Like money you don't have, sometimes you don't miss. But that earns interest on interest. And if you're like, I forget what's the gentleman's name in the back, you are? Bill. So this example was built for a student, 1,000. But Bill's got $1 million in his account. So just imagine this compounding on $1 million, JJ. I'd be nice to this gentleman. He's looking for a graduate assistant. Get his card, yeah, for you. But over the 5 years, we end up with 1,610 when you would have expected like 1,500 at $100 per year. So a simple example of time value money are compounded. Earning interest on interest. Which is why rule number 3. If you start early, well, let me pose a question to you. Let's see, Mickenbauer. Who do you think is the smartest person in this room? Besides you? Zach! Oh. Zach must be his teammate. So Zach, let's say you're going to retire at 65. I'm going to retire at 65. Who's got more years between them, their age now and 65? You or me?
I did.
Oh, damn, he's not so smart. He's in my class. I'm failing. Yes! You got like probably 45 years. So if you start saving money now, even if it's a small amount, with compounding, it's imagine. Like I'm 110 years old, so I can't go back to 65. But if I start saving now, I don't have as long as he does for it to compound. So I can't stress enough, when you guys get out of here, your first job, your companies might have some kind of retirement plan. Some are called 401ks. At Florida Texans, we're a nonprofit, they call it 403B. 2 things to remember. One is start right away. Just pick some amount and have it taken out from your pay and invest it. And the second is most of those plans now have a matching plan. What's a matching plan, other Zach?
So like if you take out $50 from your pay, they'll match it.
They'll match it. It's 100% guaranteed return. If any of you guys don't take advantage of that, when I die, I'm coming after you. I'll be like a ghost. Telling you, especially you, man. And at least get the match. It's free money. Your money plus your employer's money starts compounding for 45 years. And who knows, maybe you can retire at like 35. Maybe not. But you have a lot of options if you start saving. Get you into good habits, it starts building up, and someday you look at your account and go, wow, got that much? That's crazy. So start early. Don't pass it up, because you're going to go, oh, you know, I just got out of school, got this, got that. Find a way. At least put enough away for the match. If you could do more, that'd be great. Anybody close to graduation have a job offer or anything yet? You have a job offer? Do they have a 401k as part of it? Can we ask who it's with? Amazon! Well, he's a smart guy. They don't pay very well.
It's a 5-year development program.
Whoa, all right. Yeah, they have some really good benefits. And I'll digress for a second, which I normally do. But they also have a thing called stock options. Let's see, if we pick on someone, we'll have no idea. What's your major? What's your major?
Behavior analysis.
Behavior. Oh, this would be good. What's a stock option? Why do the companies issue those? Especially like Amazon. Okay, good. It's a good pick. Let's ask Mr. Amazon. What's a stock option?
Well, they're giving me 95K in RSUs.
On what? Oh, restricted stock option, yeah.
Correct.
But you don't know what it is?
Typically, there's a vesting period.
Okay. So I mean, you have to work for them for a certain period of time before you get it.
Yeah.
But how does a stock option work?
On 4 years, and so.
Come on in. We're waiting for you. All right. Hit enough. I got the bonus now, Nancy. I got a free book.
Wow, it's blue there.
Oh, okay. So he's a rich guy, he won't tell me. But the simple stock options work like this. The company's trying to incentivize you, certain behavior, and they want him to stay around. So they want him to do really, really good. And they say, if the company does well, we're gonna reward you. So it might give a stock option, what's Amazon's stock price now, give or take? $18 a share? 1,800. So it's around the 2,000. So they might say, the stock option says, all right, you're able to buy 1,000 shares of Amazon at $1,000, or 2,000. Let's say the stock price is $1,995. So you would not exercise it, because you could go buy it in a market cheaper. But over the 4 years he's tied there, if that stock price goes up to 3,000, 4,000, 5,000, which Amazon hopes, they can cash that in once he vests or has enough time and make a hell of a lot of money. Where usually your pay increases are going to be 2, 3, 4, 5%, maybe a little bit higher if you get promoted. But with stock options, there's really no upside, if you will. I mean, Amazon could go really, really, really high. So and some of you guys may get those as part of your compensation package. So there's the salary, the money you got in your pocket, there's a retirement plan, then there's this other thing to keep you tied to the company and highly motivated to help them succeed. And some of you may work for small companies, and they give you some stock saying, if this company becomes something, then we're going to go public. Or I heard the term IPO, which means what? Initial public. Who went public this past year? You know, the big companies that went public at IPOs? Yeti, okay. Uber, yeah, Uber. They sort of went up. There was a couple, WeWork was going to do it too. They didn't do so well. I think maybe Lyft might have went public this year too. But some of you may go to work for a small company, maybe your salary's a bit less, but they give you some of these options. So if the company succeeds, when they go public, you can trade those for a minute. Let's start early. All right, another one. Pay off credit card debt monthly. Why do I say that? Oh, did you get one of those sheets back there? Did you have the 10 Commandments? Why do I say that?
Credit score?
Oh, I got one thing that helps your credit score if you're paying on time.
Also, it says the value of the money that they buy.
Yeah, how much does credit cards, young lady back here? What kind of interest do credit card companies charge you if you have it balanced?
It depends.
On what? You sound one of my students, it depends. That,
For example, the rates are different.
give me an idea, what would be an average rate?
For example.
2%?
I have a credit card is 8%.
8%? Oh, that's a great one. I got one's 80%. No, they're like, I mean, some of them are like 18, 19, 20%. So phenomenally expensive.
The average has gone from 15 to 28 right now. Most of the major
Moved up.
credit cards are 28%.
Yeah, I mean, they wouldn't be doing that if they don't make a lot of money. So they count on us not paying our balance off every month. It's not like, oh, I'm just rolling over a couple $100. But you start adding up interest. Let's just say the number is 18% that you're going to charge. If you go to a bank right now and just have a regular savings account, you're probably getting like 0.0, maybe 1, maybe 0.001%. And if you put a secure deposit for 2 years, maybe 2%. So you get nowhere near what they're charging the other end. So make sure if you get into problems with credit card debt, one of your first things you want to do is figure out how to pay that off. Because it's very, very expensive. And you can use that money for something else. Also, don't get cards that charge you an annual fee. Because you get so many free ones. I don't know if the ones we have through the school, I see them over there advertising. I give the guys a hard time getting the suits, but like my buddy Zach, I'll pick on him again. He gets the free T-shirt that says Florida Tech with Pete the Panther on the front. You can sign up for all sorts of cards. Pay $100 a year or something. Zach, why'd you do that? Zach, give me those cards. Oh, I already talked about number 5, right? This is really getting wonky now, all right? So I talked about 401k. One of the advantages, if you have a traditional one, is you don't pay any taxes on the money you put in. Like, unlike Nancy, My salary at Florida Tech is about $25,000 a year. That I'm worth every cent of it. Or maybe it's per course, I don't know, I have to check. They haven't really told me. But if I put $5,000 in my 403B or my 401K, I only get taxed on $20,000. And then the other $5,000 I get taxed way down the road for Zach when he's 65 or 70 or whatever, something like that. So a lot of us grew up, we did these things because they're tax deferred. It's legal, you can do it. Now they have some things called a Roth, where you could pay the taxes now and not pay taxes later on. Some of those may be better for you guys. But the thing I want you to remember about the tax code, that there's two terms. There's tax avoidance and tax evasion. One is legal, and you should do everything you can to avoid paying taxes. And the other one's illegal, and like that young lady there, we go into jail if you do it. But the tax code is very complex, very crazy, doesn't make a lot of sense. But if you can take certain deductions and tax credits, because you paid attention to what's going on, you structured your finances that way, you should do that as best you can. If you end up paying zero to the tax collector in the year, that's good. As long as you learned how to avoid it and you followed the tax code. Now, if you just don't report your income, that's evasion. Someday they'll catch up with you, then you'll be in trouble. But the more money you keep for yourself and don't pay to the government, and I'm not anti-government or anything, but it is a very complex system, but it's worth you taking time to learn the system. Because there may be certain things you can do or not do that will help you take advantage of it. But the more you keep in your own pocket, you have that to spend, or you can go save it and have it build up for your whatever you want it to do for you. So the key is, remember, tax avoidance is legal. And we just went through like a tax overhaul. So 2018 was confusing for a lot of us. Like one of the big things used to be, if you made so many in charitable deductions every year, you could take some deductions from your taxes. That sort of upped that limit. But for some folks, if you can make a big donation, you might want to go group of 2 or 3 years amount you give to a charity, do it in 1 year. Fully legal. A lot of us will write checks this December, and then maybe not next December. But, you know, that's what the taxes say, you can do that. Bunch them up, 1 year you do it, the other year you do something else. Any questions while you're going here? This group's too quiet. Because we're going to what, 9 o'clock? See how long they stay. All right. Oh boy. Oh boy. This gentleman right here who's filming me with my red hair, he asked this question. So this is my advice here. Beware bubbles, fads. Remember the 2000 housing and 2008 housing crisis and 2008 .com. So back before you guys were born, any company like in the 1997, 98, 99, if they, whatever their name was, like pet.com, webnd.com, if you had .com after your name, you were like $1 million company. We just go invest in the company because it said .com and they're going to take advantage of the internet. And how'd that turn out for us? Not very good. All of these companies that were losing money, they weren't selling very much, but people invested tons of money into them. They went kerplunk. Which you thought would have woken some of us up. It's like, you know, it's too good to be true. But these folks, there was not unlimited potential. They weren't all going to be successful. They didn't really have good business models. And just because they had .com doesn't mean that they were going to be successful. Then we came along, we had this other thing that we believed, that housing prices would always go up. So the whole back row there, what they would do is go buy any house that was on the market, Bombay, Melbourne, India Atlantic, fix it up, turn around and sell it a month later for about $100,000 more than they bought it. This is great, I could do this forever. It's like free money. Because prices always go up. Until what happens? They don't go up anymore. Yeah, that they were giving loans out for basically people that didn't have salaries. People were moving to $1 million houses that were making $25,000 a year like me. And at some point, you know, housing prices, they said, you know, maybe there is a rule that things don't go up through the ceiling. But a lot of us, we watched that. go, that seems kind of crazy. But we invested in companies that invested in those kind of companies. And our stock portfolios took some big hits. I think around 2008, in 1 year, my retirement plan lost 40% of its value. It's like the gentleman in the back, I had $1 million portfolio. I was ready to retire, JJ. I was moving to London. I was gonna visit the Queen, have tea with the King or whoever he is, talk to Meghan, don't get out. Oh, that's right, there's the
Yeah,
King
just
right
a
here.
quick question there. How do you insulate yourself against the problem people had that they did invest into real estate or property, but the companies that they invested with plowed all the money into real estate and they all lost everything they owned because of the bubble crash? And they didn't, the people who invested money didn't even know.
Didn't realize it. My answer there would be, know what you're investing in. Because we're gonna talk about mutual funds in a minute. And mutual funds, we put some money into this pot, and some other people, like these two smart dudes here, they go invest it in a bunch of different companies. You know, my advice is you should at least do enough due diligence yourself to know where it's seeping to. Now, can't look at everything, but a decent share of it's getting set in some of these markets you don't want to. You know, now, like, what markets would scare you now, given what's going on in the world? Which one? Black market? Yeah, that always scares me.
Oil and energy?
Oil, yeah, right? With all the stuff about climate change and those kind of things, I'd be very careful. The money's getting plowed into coal or gas, oil. That would concern me. Where else? Newspapers, yes. I love newspapers. You know what? We should have a good library staff here. And they'd have the New York Times every day. I'd come all the way from the College of Business just to come here and get that paper so I could read it. Then damn Nancy stopped it. She says, now you gotta go online. Like, oh God, it's not as fun to read it online. You know, I can't turn to pages. I rip things out and take them to class. In fact, I think it was this last weekend, Gannett got bought by some company called One Media. So they consolidated like 200 some odd print papers and 150 online things. Yeah, watch out. There could be some opportunities if you pick the right person, because probably someone's gonna survive. But that general marketplace would scare you. How about the company Juul in vaping? How's that sound for an industry right now? If you got some money, I'll invest it for you. What's going on in that marketplace?
It sounds like talking off, well.
People die from their products. It's never good when people die from using your products.
I know they're trying to like have more restrictions and stuff.
Yeah, probably, right? I mean, you see,
Some pharmaceuticals.
yeah, a lot of pharmaceuticals. How about Purdue Pharma? Oxycodone. Yeah, some of those, I mean, that's what I'm saying. You got to do a little bit of due diligence because different companies get in trouble. Sometimes maybe it's too late for you or you go, oh, it's so diluted, it doesn't really matter. But if somebody's overweighted in one of those areas, you really want to watch out for it. Yeah, I mentioned, yes, sir.
I heard that we should watch out also for the technology companies nowadays because they have high valuations and not people are .com era. Is it true or not really?
Well, I don't give that kind of advice. What do you think?
I don't know.
Well, and technology is broad again. I mean, that's a field you always got to watch, right? Because there's some things that are kind of hot. And I mentioned this one company, WeWork. I don't know if you guys have heard of them, but they were the ones that went out and spent tons of money to buy buildings, they retrofit them, then they would rent out little small workspaces. They must have went, I don't know, billions and billions of dollars worth of debt because they had office space all over, and a lot of it was being rented out to some of the technology companies. But people started looking at their financials going, look at all the debt they got. You know, they'd have to make $1 kajillion just to pay off the debt. So they had this high valuation because people were plowing money into them. But when people started actually looking at what was going on and the business model, they said, I don't think so. So its valuation has plummeted quite substantially. Now, when you say technology, I doubt Google or Amazon are in trouble. Probably Facebook is okay. But there's another tier out there that, you know, biotech's another one. And these crazy guys, I don't know what it is, but they talk about this CRISPR stuff.
So are they typically the returns are unrealistic compared to general blue chip stocks, things like that they might be 20, 30% higher? It's again, give me 12% back and the market doesn't do 12%.
Not forever. Not forever. I mean, right, certain years it will, but not forever. But Amazon's betting on growing forever.
So I've got two questions.
Sure.
So my plan is to retire in 8 years.
8 years?
Yeah. And so I have a
Okay.
Specifically in the island of Jersey, for inheritance, and also, maybe the Cayman Islands, potentially.
Well, the second one, I'm not an expert there.
Oh, yeah, that's.
You know, and what he's talking about is there's some offshore places where people take money for taxes because they have better tax treatment. I don't know enough on the US side.
Okay, that's fine.
I would get you in trouble and me in trouble, but I could refer you to some tax attorneys that would understand it better than me. Another thing that's good to know about with this stuff, that you're gonna learn a few things, but you also know what you don't know. And sometimes you have to hire people that know more than you want to make sure there's people you trust. But don't go off wildly doing stuff. But that offshore tax things, make sure you're got those right. So can you sketch the plan? 8 years, that's kind of amazing.
Yeah, yeah, so essentially it's, just gonna be, $1 million into broad-based index funds.
Okay,
So it's gonna be split 70-30, so 70 into, stock index fund, 30 into a bond index fund, most likely through Vanguard.
okay. Why
Um,
Vanguard? Listen to the name Vanguard. Why Vanguard?
Why Vanguard?
Yeah.
Because they have historically had the best returns.
Good returns. Also, Vanguard was a leader in really, really low-cost investments.
Yeah.
We won't get deep into that, but when you put your money like in the plans that, say, Tech has, or Vanguard or Fidelity, they charge you some money for managing the funds. And the more they charge you, is the less money you have working for you. But Vanguard came in and rock bottom things. A lot of you guys will also see what's called robo-advisors. They won't be talking to people. They'll be smart guys like this are going to program bots. So they'll come out and say, well, you know, what age are you? When do you want to retire? What's your risk? What's your tolerance for risk? And they'll come back with recommendations. AI, basically. Right? You guys are probably more comfortable dealing with that than me. I like talking to an individual. But yeah, that makes sense. Okay.
So that income's gonna be taxed. As far as like, tax deferred accounts, so I'm obviously gonna put the max of 16 into a Roth. Probably gonna do the 4%, so Amazon is a 4% match.
Okay.
They do 50% up to 4% of your annual income.
Okay.
So I'm gonna max that out at the 4%, and then I'll probably put 1K into an FSA.
Okay.
Um,
What's FSA stand for?
a flexible spending account.
Okay.
So it's
Another tax thing. Again, he's getting way out. He's like an MBA student, so he's trying to impress us here. Trying to get a grade. No, I'm just kidding.
Am I missing
But
anything?
but the FSA allows you to put some money aside for certain kind of expenses, but basically it's not taxed. Yeah, ever.
But you lose it. But you lose it at the end of the year. So I mean, you gotta.
With them, you do? 'Cause some allow you to roll it over up to
Yeah.
a certain amount.
Yeah, some HSAs do, but the flexible accounts typically don't. But anyway, am I missing anything?
Well, if I could, I'd rather we talk to the side about before I answer that question.
Okay.
I don't know enough about the background. I mean, you know some things which are good, but I don't know enough to tell you whether it's good or bad or whatever. Do you know how much you need to live on?
Yeah.
Okay, all right. That's using the time value money principle. So he's saying, in order to retire at 8 years, I need to have so much money so that every year I can take out X amount. He takes some $100,000 to live on or something like that. So he's doing a calculation right now. How much do I need that money I've got today to build up to in the year 2027? So I can take out $100,000 per year for the next 50 years.
So I'm going off the Trinity study, so 4%.
Okay,
Of
is what you, okay. Yeah, but you want to look at your lifestyle,
course.
because are you single at this point?
No, Mayor.
Okay. 5 or 6 kids?
No kids.
You'll have 10 by the time then? That's something you gotta remember too, because if you have children, that changes the equation.
Yeah, so.
Those suckers are expensive.
I got the 529 built into.
All right, so you got a college savings program for them. That's good, that's good, that's good. But if you don't mind, I'll talk to you afterwards. Yes.
Just an interesting kind of observation. Some investments recently, like the marijuana industry, that is legal.
Cannabis.
Yeah, cannabis and cannabis products are legal in many states. But one of the things that has been interesting in the news is that people are investing in these companies who aren't American citizens, who aren't green card holders, visas, things like that.
That's how JJ got his
And
visa.
the immigration has been denying visas based on the fact that because it's federally illegal,
Yeah.
you are investing in illegal companies. So that's a really interesting matter. I don't want to comment.
Well, that's why the industry has been somewhat constrained.
Right.
Because in certain states it might be legal, but the banks are afraid to go into it because it's not legal federally. So a lot of these cannabis guys are collecting cash, and they gotta carry it to the local bank, who doesn't have affiliates around the country, and it gets kind of unsafe and stuff like that. So they go, yeah, you gotta make it. And that's another one, talk about speculation. It seems like it's gonna be a huge market. But each state's come along and a little bit different regulations. The federal government, at least right now, is saying, we want no part of this. And until they come on board, it's gonna be really hard to build a pretty big business.
Is it still legal on if it's traded on the US stock markets? Is it legal?
There are some companies, there are some companies, cannabis companies that are publicly traded. So that leads me to my last point on that number 6. So the question was Bitcoin cryptocurrencies. Would you put money in those? Gentleman back here, why not?
I don't know about it, and I don't think, I heard is, the value of these currencies is based on demand, so I heard about it. So unless somebody wants to pay for it, it doesn't have value.
Okay, but that's true for any investment. Unless somebody's willing to buy it, you can't sell it. But there's probably a little bit less demand there, all right? But you said something at the beginning. I'm sorry. Yes, sir.
I was going to say it's also highly volatile. Went, I think, from 6 or 5,000 to 11 or 12,000, and now it's back to 7,000.
Yeah, I think it was two Christmases ago, it was like 20,000. All my students were excited, then it dropped to 6,000, and went back up to 8. Yeah, it's volatile. Remember that test you took? But how's your stomach feel? How you sleeping? So if you like that kind of volatility,
I wish I'd kept the 10,000 Bitcoin email I got when it first started. Everybody was testing it and sending 10,000 Bitcoins out, and it was worth nothing back then, but you deleted the emails, so.
and that's one,
Now you're very good.
you guys are right in that market. That when you walk out of here and get a job, there are companies where you can invest that are Bitcoin companies or cryptocurrencies. Me being an old guy, what scares the hell out of me is there's no government backing. There's some crazy Florida Tech computer science guy made up the number of Bitcoins are out there. So some of you clowns are mining those things. It's like, how do we get more? How about if this guy starts mining more, and now we double the supply overnight? Won't that hurt the value of this thing? And I just don't know, who do you go to? Who's in charge of this thing? So if it all blows up, it's something like Phantom Guy in Japan or something, isn't it? Now, I think some of the underlying technology, the blockchain and some other stuff that's going on, a lot of companies are adopting that now to track things. But the whole cryptocurrency, that one scares me.
Like the cryptocurrency is using like other stuff that are like not legal. So like when you do something under the table, they use a lot of cryptocurrency. So that
Yeah, that's sort of the dark web now, right?
not just the dark web, but like, so I think that's one of the things that will make it keep its value, because you'll always need it.
Oh, so I make some money off the drug dealers. Megenbauer! We've been talking about ethics in class. But that would scare me though, if somehow, some way, law enforcement ever finds out or goes after those kind of things. You're kind of on shaky ground. That's another thing about investments. That there are funds, a lot of them appealing to you guys, what they call environmental social governance. But they stay away from gun manufacturers, tobacco manufacturers, maybe oil and gas. Whatever those things are that you don't want to invest in, they're saying, we're not going to put those in our portfolio. And the data is not real robust yet on whether they have a higher return or a lower return. But you may have certain personal preferences to go, all right, I'm willing to take 1 or 2 less return per year because I just don't think it's right to invest in these kind of things. But that's your personal opinion. As long as you make an informed decision. Yes?
Yeah, I just looked over a lot of my investment to socially responsible funds. And he said, you won't get as much money, but it'll be steady, just like the other. And I'm now getting full Social Security because I waited till I was older to get it. So I have a lot more money every month than I usually need, except when I had to replace my roof and I have an old car and an old I had no idea the air conditioner furnace. I had no idea how it is from this relative house I bought and have a 12-year-old Yaris. So I know I need to, say chunk money into a savings account. I'm doing that.
Well, as long as you made an informed choice,
Yeah.
you want to be in certain kind of
Yeah.
investments. That's good.
What can they do to avoid something like the Bernie Madoff thing? Because, these were...
Number one,
Oh, number one?
seems too good to be true. Bernie's promising you guaranteed 20% per year forever. There was higher returns in the market over a long period of time.
What-
And there was no, I mean, people look at it going, he's not a Warren Buffett kind of guy. I mean, how is this happening? You know, you look at the reputation of who it is. I mean, folks just get greedy, right? Get greedy around money. And it happens for a couple of years ago, why not?
The
Let's go
question
back
I
to
had
the
was,
mutual funds where people lost all the money because they invested it where they made it. And they weren't invested, they were instead funds, but the company invested.
Yeah, but those are mostly high-end investors. You know, you and I weren't getting it. But yeah, you're right. Some of those folks, they invested with one person who then chunked them off to different places.
well, even when you're careful, like through my employer, I was principal, I was nonprofit, but I had the maximum taken out by law, and then they did, at one point they matched, but then they stopped, but and so then when I got older, they could even take out more, and plus I put money in a Roth IRA, but I had money that they kept flipping the investment companies, and this was a principal, I guess, at the time when things went bad. But I had money in New York Life, and they wanted me to put that money in. I said, no, I'll let it sit there. And I did, and I'm glad I did, because like you, I lost a big chunk of money. I didn't lose it because I kept investing throughout
Right.
those bad times, so when it popped up, everything popped up. That's why I'm able to be here before it.
If you have extra money, just send it my way.
Yeah, but
I'll help you out.
But the thing that got me was, okay, New York Life, 25% was fixed. It was like 4% or something. And so everything was down over several years, except for that little 4% kept chugging along nicely. And then, of course, the rest of it popped up eventually. But I even lost money in the fixed, in principal. And so I went to HR about how come I'm losing on fixed. I said, because I had fixed and I had aggressive and I had balance, so I was diversified, so that at least I won't lose money in fixed, but I did. Oh, well, the answer was, fixed doesn't mean guaranteed. So, I mean, that kind of.
True.
So what?
Nothing's guaranteed, folks.
I thought I was being,
Well, you're being more conservative. Right.
Conservative, like having so much in fixed,
Yeah.
just like I had 25% of it, but.
I'll talk to you afterward about some stuff. As I'm talking, I'm going to pass.
In terms of the wording, I mean, I don't know if you.
Yeah, you got,
So that doesn't
well,
happen.
and that's another thing out of this, hopefully out of this one, that you guys are all very intelligent people. So when you're talking to an advisor, a banker, or a loan officer, if something doesn't make sense, you ask them again, what is that? Before you give any money, make sure you understand it. If you don't understand it, you get up and leave and go someplace where they can understand it. Because there's nothing complex about this. If you get a chemical engineering degree, if you get a behavior or whatever analysis degree, even the friggin' business people, like JJ, first year he learned how to add, sophomore year he learned how to subtract. He's now up to multiplication. He can understand those guys and ladies. Because someone will talk really quick and they'll say things like, even though we're guaranteed, they use all sorts of terms. And there's things are in vogue. Like if I use some terms now, they'll change next week.
Well,
So
one
don't get
company
caught up in it.
was, and the other company wasn't.
True. So I'm going to pass around a couple of slides because I wasn't smart to figure out how to get on the board. But this one says asset class returns. It shows different classes of assets, different stocks and bonds, conservative, aggressive, over a 20-year period. What I want you to notice is that in some years, some are up real high. Next year, they're down real low. There's one that sort of flirts around the middle, which is what they call a balanced portfolio, which a lot of us go for. I do it because I sleep better. Because I'm in this for the long term, but some years I'm going to do okay, some years are going to go down, but over the time it's going to be there, I'm going to get about the average return for the market, maybe 7-8%. Some years I get 15, 16, some years maybe it goes negative, but I'm not drawing it out. Most of us in this room, other than Mr. Amazon, cannot time the market. Everybody believes they know when to get in and when to get out, but guess what? And I have another chart that shows something like that. It shows another wonky term for you guys. I asked these folks. Do you know what a bull market is? Bull market. How about a bear market? Oh, good. Yeah. So here's how you do it. When you hear those Wall Street people talking about a bull market, think about the bull. His horns are up. So bull market is the market is going up. It's roaring like a bull. And when it's going down, they call it a bear market because the bear's paws go down. That's how I learned it 100 years ago. But this one shows the market going up, and then when we hit like a recession, it goes down and then it comes back up. And the pattern here should tell you you want to stay in the market. Because you just, when it drops, what happens, some of us get scared and we sell off at the bottom. Like the gentleman back there, we're kind of cautious for a couple of years as the market's going back up, and we buy in at the top. So we do the exact opposite of what we should do. I'll pass this one around this way here. This one here. Then another two that are coming around. This one shows a typical year of all the news stuff that happens. You know, just think about every day in the news here. Oh my God, had a fire here. Stock market fell. Next day we had a new trade agreement. It goes up. Up, down, up, down, up, down. So this one just sort of tracks over year, where if you notice a trend, it goes up the whole throughout the year with some ups and downs. But it plotted like different events that happen in that time period. Again, the advice being, don't jump in and out of the market. If you're saving for something 8 years out for your retirement, down payment for a house, for a new car, stay at course during that time frame. And I have one for these guys over here. It shows what the market did that year, this blue line, but it shows as low as it went. Like one year, at one point the market dropped by 34%. Linda and I jumped off the causeway. But for that year, the market ended up 2% for the year. So it was hard swallowing. 34%, I wouldn't pull all my money out and put it under my pillow, Zach. My wife said, don't do that. Just leave it there. And it's a good thing I procrastinate, so I didn't go to the bank. Didn't pull it out. Yes, sir.
But even if we have some news or some people talk about that we are going to have a recession soon, shouldn't we be concerned about these kind of news?
I've heard that for the last 5 years. That this is the longest bull market in history. It's coming anytime soon. So I could have done two things a couple of years ago. I could have pulled my money out of the stock market and put it in very, very conservative investments or in the bank and missed a couple good years. Or I could leave it in there. At some point I'm going to get whacked. Because at some point it's going to go down. Things don't go up forever. So the rhetorical question is, if you know when it's going to go down, sure, you make the moves. Now, you know, you probably, if you're really concerned about, again, you know, it's bothering you inside, maybe you move from not quite as aggressive, but he's going to be pretty aggressive. If he's trying to make enough money to retire in 8 years. If your time frame is 35 years, you get a lot more time. But he might, you know, you might want to dial yours down a little bit. That rather in stocks, I should have told you guys. So what's a stock? JJ, in 10 words or less, can you explain to them a stock?
It is a part of the company.
Part ownership. So Amazon,
Ownership of the company.
if he has a share of stock, he owns one share of Amazon. So it's an ownership thing. And he bought that at a certain price. If that price goes up, he can sell it, whatever the price is. But you own a piece of the company. Now, usually not very much, they don't listen to you, but it's ownership share. Then we have a bond, which is what you were talking about with more conservative. What's a bond? In 10 words or less, a bond as opposed to a stock. I'll give you an example. I saw a note from Florida Tech that they're going to go out and build a new College of Business building over there. Was business, right? Damn medical building! And I can put a College of Business over there? Oh, that's sacrilege. Yeah, the health center or whatever it is. But they're going to go out and borrow money. They're going to issue bonds. So everybody in this room, we could pull our money and we could go buy some bonds that Florida Tech owes us money. We're going to make a loan to Florida Tech. And they'd pay us interest probably every 6 months. Do you trust them? Don't say that. Don't answer anything. Dr. McKay, just kidding. But, you know, so a bond, a stock ownership, you know, could go up, but also could fall. I have a lot of stock in Blockbuster. Jay said, video is always good. And I used to always go there on Friday nights. I love Blockbuster. How much is my stock worth now? Oh, damn. No, it can't go negative. It can only go to zero. It can only go to zero. But I pay $100 a share for it, so I lost all my money. So you're betting the price is going to go up. On the bonds, I'm betting on the company staying in existence. Not my Thomas Cook. They wanted people to loan them money. And folks said, no, bank decide your past history, all the debt you got, people booking online. I don't think you're going to make it. But Florida Tech is going out to borrow money. They may have to pay a pretty high interest rate, too.
Are they tax-free bonds?
I don't know. They might be. Don't know. I'm getting near the end here. See if I, yeah, so number 9 was what I was talking about. Don't be afraid to ask someone to explain things to you. I did the bank the other day, and I had no idea what that person was talking about. Absolutely none. Asked them 3 or 4 questions. I don't think they knew what they were talking about. I said, yeah, we're not going to do this. I should be able to understand that. And you guys are smarter than me. So don't be afraid to ask questions like you. You guys have some good questions. And the last thing is personal advice. As an old guy, money's fun to have, but it's not everything. You know, it's got to have a balance in your life. You want to live comfortably, but you also want to have some fun, enjoy what you're doing along the ride. And with that, if you guys want to get your phones, I'll give you my name and address, or email address if you want to get a hold of me. If I have to answer questions later on, I think I ran out of time. It's just tmuth@fit.edu, tmuth@fit.edu. Charges $1,000 a minute. But since you won't pay me anyhow, it doesn't really matter. Are there any final questions? I don't want to keep you guys. I have another article for you guys, 2 things actually. So one is another survey, it's called Investment Risk Tolerance. So when you get ready to take that job and put money into a mutual fund or whatever, this gives you some idea of how risk averse or how risky you are. And then for the young folks, I found this article where some financial pros gave advice to young people to get ready to start out.
I have a question.
Yes.
As you go through your career and you move from job to job and you have like different work plans, does it make sense to keep them diversified as you move from job to job, or should you keep rolling it into one?
Well, the diversified is probably not the word, Nancy. It says, I would advise you to do whatever's easiest for you. But usually, like, so if you went from Florida Tech and you went to work for somebody else, you could take that 403B and probably roll it into the other plan, and that way you only have it in one place, rather than have 2 different things that are out there. But diversification would be what those assets are actually invested in. Yeah.
Within it.
So I find it simpler to sort of put it in 1 or 2 baskets.
Right, to keep track of it.
Thank you for coming. Any other questions? I'll hold you guys up. I gotta go wash my hair and pray like hell it comes out. Good. Thanks for coming. Appreciate it.